If you were to rank the world's economies by size, the Vatican City-State would barely register. It is the smallest sovereign state on Earth. It has a population of less than 1,000 people. Its official territory is smaller than a single golf course. But if you measure power by influence, assets, and historical capital, the Vatican is a giant. For centuries, the Holy See has operated as a unique financial entity. It is a dual citizen of the global order. On one hand, it is the spiritual center for over 1 billion Catholics. On the other, it is a sovereign financial jurisdiction with its own bank, its own real estate empire, and its own diplomatic immunity. This dual nature has created one of the most complex and opaque financial systems in history. It is a system built on faith, funded by donations, and managed through a labyrinth of investments that span the globe. For decades, the Vatican's finances were a black box. Money flowed in from the faithful in Boston, Buenos Aires, and Manila. It flowed out to charities, missions, and the maintenance of priceless art. But in between the donation and the expenditure, the money moved through channels that were often invisible to the outside world. This is not just a story about religion. This is a story about a sovereign wealth fund with a soul. It is about the tension between spiritual poverty and material wealth. And it is about how the oldest institution in the West is struggling to survive in the age of digital transparency. At the heart of this financial system sits the Institute for the Works of Religion. Most of the world knows it simply as the Vatican Bank. But calling it a bank is technically incorrect. It is a privately held financial institute located inside a sovereign state. It does not lend money. It does not issue mortgages. It does not have shareholders. Its purpose is singular: to safeguard and manage funds for religious orders, cardinals, diplomats, and Catholic institutions worldwide. For decades, this structure offered a powerful advantage: privacy. Because the Vatican is a sovereign state, the institute operated outside the jurisdiction of Italian or European banking laws. It functioned as an offshore tax haven, not hidden on a distant island, but embedded at the very center of Rome itself. This unique position allowed religious orders to move funds across borders with minimal scrutiny. It allowed the Church to finance missions in hostile territories during the Cold War, where traditional banking channels were either frozen or monitored. But secrecy is a double-edged sword. The same walls that protected the Church's legitimate funds also created a blind spot. Without external audits, without compliance officers, and without transparency, the system became vulnerable. It became a quiet place where money could disappear and reappear without leaving a trace. The assets under management are significant: billions of euros in deposits, investments, and gold reserves. But for a long time, the true value of the Vatican Bank was not its balance sheet, it was its silence. That silence was shattered in the late 20th century. The collapse of Banco Ambrosiano in the early 80s remains the definitive scar on the Vatican's financial reputation. It was a classic banking failure involving bad loans, shell companies, offshore structures, and the mysterious death of its chairman, Roberto Calvi, found hanging beneath London's Blackfriars Bridge. The Vatican Bank, as a major shareholder, was dragged directly into the wreckage. The scandal revealed a dangerous truth. The Church's financial advisors had been playing a high-stakes game with secular money, far removed from spiritual stewardship. But the damage wasn't just financial, it was reputational. The institution that preached morality was caught in a web of distinctly immoral transactions. It created a crisis of confidence that would last for decades. In the years that followed, investigations pointed to accounts being used for purposes far removed from charity. There were allegations of money laundering. There were questions about the origins of large cash deposits. The Vatican found itself in a paradoxical position. It held supreme moral authority, yet its own financial system was viewed with deep suspicion by the global banking community. Major international banks began to quietly close their doors to Vatican accounts. They de-risked. At one point, the Vatican was so isolated from the modern banking system that credit card terminals inside the Vatican museums briefly stopped working. The message from the global markets was unmistakable. Sovereignty is not a shield against accountability. The turning point came not from divine intervention, but from regulatory pressure. In the wake of the 2008 financial crisis, the world declared war on tax havens and money laundering. The Vatican faced a simple choice: reform or exclusion from the global financial system. Under Pope Benedict XVI and continuing with Pope Francis, the Holy See began a painful and unprecedented process of financial modernization. External auditors were brought in. Compliance experts from Switzerland and the United States were hired. The Vatican submitted itself to the Moneyval evaluation process, a rigorous anti-money laundering assessment conducted by the Council of Europe. Moneyval was not about theology. It was about credibility. And for the first time, the Vatican's finances were being judged by the same standards as every other state on earth. The cleanup was brutal. Thousands of dormant or suspicious accounts were closed. The Vatican Bank began publishing annual reports, revealing its profits and assets for the first time in its history. A new financial watchdog was established, the Financial Information Authority, tasked with monitoring transactions and reporting irregularities. This was nothing short of a cultural revolution. Cardinals who were accustomed to handling cash in envelopes were suddenly filling out compliance forms. The Vatican was forced to adopt the same "know your customer" rules as a bank on Wall Street. It was a collision between medieval tradition and modern bureaucracy. But it worked. The Vatican is no longer a financial pariah. It has largely reintegrated into the European banking system, trading secrecy for survival. Today, the Vatican economy is in a state of transition. It faces a thoroughly modern problem, a structural deficit. Donations are declining. The cost of maintaining centuries-old buildings is astronomical. Pension obligations for Vatican employees continue to rise. The Holy See is now managing its assets not for secrecy, but for sustainability and yield. Investments are being consolidated. Financial control is being centralized. The Vatican is acting less like a medieval court and more like a modern institutional endowment. But the central tension remains. Can an institution built on faith effectively manage a global financial portfolio without losing its moral authority? The reforms have sanitized the system, but they have also exposed the reality of the church's wealth. Every euro spent on a luxury property in London is now a euro scrutinized by the faithful. The era of God's bankers operating in the shadows is effectively over. The Vatican has learned that in the 21st century, the true currency of trust is transparency. The ledger is now open, and for the first time in history, the judgment may come not from heaven, but from the numbers themselves.